First up, we have elders, Tom Rosso, the Executive General Manager of Branch Networks. Could we please give Tom a warm welcome?
Good morning. Thanks, Max. All right, I won't get into any small talk. I think I've got 20 minutes. It feels a bit like speed dating. So we'll run pretty hard at a pretty high level, and hopefully I can save some time to have some questions and some interactions at the back end. Today, I thought, given that I'm the first up, I just wouldn't mind taking a little bit of time on behalf of my industry colleagues in the room to do a bit of context setting, talk about why it really is an exciting space to be in ag at the moment in Australia, before turning to our business model, looking at and how that's allowed us to have resilient financial results through the cycles, as is the theme today, before moving to the 8-point plan, which is our famous strategy. We're into our fourth 8-point plan, and then talking about our sustainability ambitions, both within our business but also for the industry. So in terms of context, we just heard about the growth in population that's fueling demand for agricultural soft commodities. I think over the last 10 years, we've had a real boom, and all of the excitement was around China, this growth in population. Now I've noticed the dialogue is really changing towards, China's maxed out, we're actually going to see a decline in population, what does that mean? And the reality is we're still going to see strong growth in global populations, but more importantly, we're going to see more affluent populations. And importantly for Australia, that's happening on our doorstep in Asia. So, China, whilst it may not continue to have that boom in population, we're going to see the rise of the middle class, and they're going to gravitate to different types of food, different nutrition. So things like high value products, proteins, beef, dairy, sugar, those types of commodities are going to be in hot demand. And of course, growing populations will continue to fuel demand for staples, things like fish, crops, etc. We're also seeing a shift in non-food use of crops into animal production, which is going to have to happen at scale globally to meet the demand, and also fuel uses as well. So it's really a story of robust supply and demand. I think it really paints a picture for an exciting backdrop around investing in that supply response in Australia. And I do a lot of work in the investment scale farmland transaction space. And one of my observations there is that the weight of capital looking to be deployed in this industry is extraordinary. I had a meeting a couple of weeks ago with just one fund manager who's got $11 billion allocated for agriculture this year alone. So it's an exciting space to be. I think the real challenge, as you've just touched on, is how do we actually achieve this productivity uplift, this supply response sustainably? And what it boils down to is how do we do more with less? So moving on to elders and our business structure, I've probably got a mix of people in the room that follow the company closely and those that might not know us at all. We've got a diversified portfolio across a lot of different product areas. A lot of analysts in ag, or a lot of portfolio managers in the equity space always say to me, Tom, how do I derive sort of a sustainable earnings base for elders that I can whack into my model and figure out what you guys are worth? And they want to see, flat lines and straight earnings growth. And the reality is in agriculture, you can't do that. It's a cyclical industry. But I think what we've been able to prove with our model is that we can deliver good growth through the cycles. In poor seasons, we can provide a good return. In really great seasons, we can provide an outstanding return to our investors. When we sat down 10 years ago, post-turnaround, to just think about our strategy, we really focused on three things. And the first was controlling what we can control. We can't control what the Bureau is going to forecast. We can't control how much rain is going to fall from the sky. We can control our cost base. We can control where we choose to deploy capital. We can control how we seek to grow the business. Secondly, we set some fundamental financial targets for the business. We work off a 15% return on capital target, and that informs every decision we have in the business. If you bring a business case to our executive committee and it has a below 15% return on capital, be prepared to be absolutely grilled. Unless there's a really great strategic reason why we should do it, we won't do it. And we're also aiming to achieve 5 to 10% EBIT and EPS growth through the cycles. The other thing that we've done is worked on a diversified portfolio to mitigate our risk. So the beauty of our structure is that we can, at any given time, perhaps we might be having a difficult cycle with one of our business units, but typically it's not across all of our product areas. So we're able to smooth the volatility in the agricultural cycles through our diversified structure across product areas. It also importantly gives us multiple channels to growth. So we can look at in each of those different business areas, whether it's our high capital use areas in rural products and our feed and processing business, or whether it's in our super high return on capital businesses, real estate, financial services agency. We can balance the portfolio and grow in each of those units to achieve a blended return on capital that's really quite attractive. We can also diversify within each of those product areas. So we're really mindful when we're doing business development and growing the business to make sure that we keep that portfolio balance right. Probably in recent years we've been a bit heavy on rural products. We're now working on beefing up, excuse the pun, a number of our high return on capital divisions. So we've onboarded a lot of great agency businesses in the last couple of years. Our most recent one was our Knight Frank business in Tasmania, about 120 people, market leader, but importantly it has a commercial agency, commercial property management and evaluations business. And so we have ambitions of leveraging that platform to build out the number one commercial agency in rural and regional Australia. One of our great agents, a guy called Ken Drysdale, Ken's no longer with us, he was a beautiful man based out of Geelong. He used to say to me, "Tom, only the sun touches more of Australia than Elders." And I think that was Ken's romantic way of describing our geographical diversification. You can see we've got a good balanced portfolio across Australia. Importantly, Australia's a really big place, and so people talk about seasons. Well, there's lots of different seasons in Australia at any given time. We might have late rainfall as we've seen in the west, but over in the east we've got great subsoil moisture and great conditions for a great winter cropping season. Typically we never see a situation where all of the agricultural regions in Australia are under stress. So that's the obvious diversification benefit. The other one is it gives us access to lots of different segments, and we have segment variation. So I'm thinking, dryland cropping, broadacre cropping, beef production, dairy, horticulture, viticulture, all of those different spaces we play in, and that gives us an obvious hedge as well, both commodity price hedging, market conditions, seasonal conditions, and so on. So this is really the result. I think this is our earnings resilience through the cycles. So we, as I said earlier, we've worked off an 8-point plan as our sort of plan on a page, our strategy. This year we're into our fourth 8-point plan. We've gone through 3 cycles prior, and you can see from this slide the earnings resilience and growth that we've been able to achieve through those cycles. And at the bottom you can see a lot of the headwinds that we've actually endured. We've endured droughts, El Nino, pandemics, supply chain constraints, commodity price fluctuations. All of that is what we can't control. But by controlling what we can control, by diversifying the business, we've been able to achieve really great growth through the cycles. This year's a really great example. First quarter, the Bureau came out and smashed sentiment in the marketplace with a pretty poor forecast for dry conditions, which didn't eventuate. We saw livestock markets impacted. We saw delays in summer cropping rotations. But pleasingly, as we've come through that, we're outperforming prior corresponding period in the second part of our half. We work off an agricultural cycle, so year-end 30 September. And we've recently reaffirmed an EBIT guidance of 120 to 140 million for this year. This just reaffirms some of the key metrics around our ambitions and our commitments to our investors and what we've delivered over those 5 years. I just want to really quickly touch on costs, because this is something that's a badge of honour for Elders. In agriculture, managing your cost base is absolutely critical through the cycles. If you get fat and lazy, if you get arrogant through the heady years and through the peaks, you can very much be left with your pants down when you come through the troughs in the cycles. So you've got to be super disciplined. Unflinching financial discipline is the term we use at Elders. We've got great cost culture through our whole business, right down to the front line of the business. Each individual branch, each individual business unit, we give them tools and education around the key cost drivers in their business and help them to have optimisation plans for their branches, and then right up through to our executive committee. So For example, this year my colleagues and I set ourselves a target of $10 million of cost or optimisation in the business, and we're well on our way to achieving that halfway through the year. That is not cutting heads and removing people, that is looking at every single aspect of the business, from fleet management to IT to all sorts of real estate, all sorts of other things to take that cost out. So it's a process of constant continuous improvement and discipline around cost base. And as you can see, if you exclude acquisition, cost-based growth, and if you exclude transformational projects in our business, to the 12 months ending at the close of the first half, we had a 1.8% cost base increase, which for us is a badge of honour, particularly in the high inflationary environment that we've been operating in the last couple of years. Turning now to strategy and the 8-point plan, I've talked about our financial ambitions, but this is our strategy: run, transform, innovate and grow. There's lots of different initiatives that sit under each of those. I thought today I'd just run you through a couple of our key strategic initiatives. In terms of streamlining our supply chain, we've grown the business quite dramatically over the last few years by entering different parts of the supply chain. So we've acquired a large wholesale distribution business via which we get market share through independent retailers. That's called AIR. We've also had a backward integration strategy in our agricultural chemicals business. So we bought a business called Titan, which gave us access to about 160 actives that allows us to, so it's largely a generic chemicals market. So we're moving into the backward integration through there. We've got a similar strategy in our veterinary products, our animal health market. We've got a formulation facility now that we acquired last year in Eureka. So we've got all these different businesses, and they're all working well together, but the reality is, if we're honest with ourselves, we really haven't integrated them properly. So this is a massive multi-year continuous improvement project that we've got underway, which we think can release about 10 or increase our NPAT by about 10 to 18 million, but importantly, release our inventory by 50 to 80 million dollars. And working capital utilisation and efficiency is a massive focus in our business. Growth priorities, I touched on that earlier. 9 acquisitions last year, we've already completed 10 this year. We've got a great pipeline coming at us. The point I just want to make here is, yes, there are a couple of really dominant players in our space, in us, and you'll hear from Nutrien today as well, but this is still a very fragmented market. There are lots of opportunities to fill geographical gaps for us. There's lots of opportunities to onboard independent agencies, independent rural retailers into our business. We have a very well-tested and very disciplined acquisition process that's been very, very successful for our shareholders over the last 10 years, and we'll continue to work that through. An example of a transformational project is our wool project. So we took a view that we wanted to participate in further EBIT pools through the wool supply chain. We've established in the last 2 years 2 facilities, one in WA, one here in Victoria, down at Ravensthall. The Ravensthall facility is the largest. It's got about a 60,000 bale storage capacity, but importantly, it gave us an opportunity to set up a wool handling and storage division that had very much had sustainability as a key pillar. You can see in that picture the Elders logo. That's actually a solar array sitting on top of the Ravensthall facility. It's super energy efficient. We've got AVGs running around inside doing all the work, which delivers both energy efficiency savings but also safety benefits for our people inside the business as well. So we think that has an ability to deliver us another $4 to $5 million in EBIT at a return on capital over 15%. So moving now to sustainability. I think sustainability at Elders, we see it through 2 different lenses. One is our own footprint and what we can do as an organisation and what we're responsible for, and the other is actually acting as a leader in the industry to implement sustainability across the business, across the industry. So I think we're well ahead of our target projects that we set a couple of years ago around waste management. We're well ahead in terms of rolling out our solar array and reducing our energy use, ethical sourcing platforms. We work in the big bag recovery, lots of different things that we do in the industry, which is terrific. But the reality is most of our emissions come from our Killara feedlot, our feed and processing business, which is probably about 65% of our emissions, and another sort of 30% of our emissions come from our energy use, which is essentially burning diesel in our fleet. So we need technology solutions to enable us to mitigate those emissions. The livestock emissions is a global issue. I think in terms of growth in emissions from the agricultural industry globally, 80% of those over the next decade will come from emissions from livestock production. So there's no silver bullet. There's some great advancements in terms of animal feed supplements, new forage feed, et cetera, that can actually reduce methane emissions. And obviously we can also look at sequestration to offset the emissions as well. So that's something that we're actively working with industry on, we're working with research bodies on, we're running trials through Kalara to assist in trying to come up with that solution. We're obviously also looking at EVs and other vehicles that we can utilise in our fleet as well. Range anxiety is a real issue in rural Australia around EVs, so there are, again, technological barriers for us, but as time goes on, we're confident that we'll see some solutions. Most excitingly, though, I think we can play a real leadership role in the industry around adoption of sustainability practices across Australian producers. I think we're uniquely placed in that we have a massive distribution network for products, but we also have a big distribution or a big network of trusted advisors to Australian farmers, whether that's our branch managers or, more importantly, our agronomists. We've got an army of agronomists out there, and we are already doing this. So, for example, last year, I think our agronomists helped over 7,000 of our producer customers. We did something like, I think it was about 15,000 soil tests across the business, of which about 8,000 of those actually resulted in people adopting precision agriculture practices within their business. So we are doing this already. It's happening. Australian farmers are wonderful custodians of the land that they work on. I think land management in this country is a net carbon sink, and our primary producers can really play a role in further building that out over time, and our aim is to help them to do that. We've established Thomas Elder Sustainable Agriculture within our business, and a lot of our technical services people are part of this. And we've got 4 pillars. One is research and development. So we partner with a lot of research and development organisations, CSIRO, big multinational chemical companies, et cetera, to run trials in real life in Australian agricultural conditions. So I think we did something like 60-odd trials last year across 12 trial sites. But the big issue with that in Australia is extension after you've done the R&D. You think about the industry, the tyranny of distance, the multiple different environments that people operate in, the different segments within Australian ag. It's hard to reach all of those, and we're uniquely placed to do that. And as I was just saying, in terms of our technical services army, our aim is to be the extension arm for a lot of that R&D moving forward. And that comes down to pretty basic things: soil health, chemical inputs, and water use, really, are the 3 main things we look at. Agtech also plays into that. Agtech is a pretty broad term. It can range from everything from new technology in chemical formulation right through to drones, sensors, better water usage, all of those types of things. We have an AgTech committee at Elders and an AgTech officer at Elders. They're constantly assessing new technology as it comes into play to figure out those that we think have merit so that we can support them in distribution through Australia. And then finally, we also have our carbon farming division. We've got some really clever people in there, much smarter than me, sort of PhDs in carbon and other things. We've taken a position that we're going to be a trusted advisor. We're not there trying to steal projects from farmers and take an unfair proportion of carbon credits off them, which I think a number of other players we've probably seen enter the market have done. We're a fee-for-service business, a trusted advisor, completely independent, and we're there to help our producer customers to start that journey towards carbon farming, further sequestration, soil health, capturing carbon on farm, and again, accelerating the growth in that net carbon sink from land management around Australia. So I think, Paul, that I did reasonably well time-wise, and hopefully I've allowed some time for some interaction.
Thanks, Tom. We'll jump to the Q&A. We'll see if we have any questions from the crowd. No, I'll ask one. So you mentioned the Kalara feedlot was 65% of your emissions, but it's only about 5% of your earnings. Is this something you'd look to sell off?
How do I answer that? I would say that that is an issue that is robustly debated at probably board level and at executive level. I think Kalara has actually been a real sustainability. We're a real benchmark in the industry and a lot of sustainability things in Kalara, like our water usage, our waste management, our animal welfare practices around shade and vaccination practices and things like that are world class. You know, we're an absolute leader. So there's a lot of sustainability things that at Kalara where we really are an industry leader in setting new benchmarks for the industry. The issue is the emissions, and that's an issue right across the animal production supply chain. So we're not the only people in that position. I wouldn't say that we're going to get scared and just sell the thing because of the emissions. Rather, we're going to look at how that we actually offset it or contribute to the industry adopting practices that allow us to minimise the methane emissions. Is that a very good cheeky question? Thanks, Max.
Yeah, given the time, we might have to move to the next presentation. But next up, we have Adrian Capagreco.